Well, first, good morning, and thank you very much for the invitation. Since the Reserve Bank is a big producer and user of statistics, I thought it might be helpful if I talk about how we use statistics, some of the changes that we're thinking about, and our wish list if we were in an if only world. So economists tend to have tough skins. We need them. We need them because we face criticism about the dismal science, about our two-handedness, and never being able to reach a conclusion. But we economists speak very well of our fellow statisticians. We know how important you are. For example, Hal Varian, who was the chief economist at Google, said recently, "The sexy job in the next 10 years will be statisticians. The ability to take data, to be able to understand it, to process it, to extract value from it, to visualize it, to communicate it, that's going to be a hugely important skill in the next decades." And it's certainly hard to disagree with that. So how intensively do we use official statistics in the Reserve Bank? The answer, quite simply, is that all our work depends upon it. But our greatest use occurs when we're preparing economic forecasts for the quarterly monetary policy statement. I see that I've got the first slide on, and there's an old saying about weather forecasters, and that is that if you say the weather tomorrow is going to be like it is today, you're going to be right 80% of the time. And maybe not true for Wellington, but that's a better record than forecasters have. The forecasts that we prepare in the Reserve Bank around the monetary policy statement, we think of them as conditional projections. So they're heavily dependent upon a number of assumptions. And they're assumptions about how fast the rest of the world might grow, particularly our trading partners, what's happening with export prices, i.e. the terms of trade, what are we assuming about the movement of the exchange rate and net migration, what are we assuming about the rebuild of Canterbury, and what are we assuming about the proportion of income that households will save and the proportion that they'll otherwise consume. What we're trying to do is to assess what we call the output gap in the economy. So let me explain. If you think of potential output as being the rate of growth that the economy could grow at full employment without generating inflation pressures, then that's an enormously valuable indicator. The problem is that it's not observable. It's derived from modelling, and it's influenced by factors such as labour productivity, the growth in the labour force, the level of investment, the quality of investment, the rate of growth of technological progress. And we think that this rate of potential output growth for New Zealand is somewhere around 2.75%. So in other words, that's the rate that we think New Zealand could grow on a trend rate of growth at full employment without generating inflation pressures. So what we're trying to do when we do our monetary policy forecasts is we're trying to forecast what the actual economy is going to do, what the growth rate in GDP will be, and how does it compare to this concept of potential output. Because when we do that, we can get a feel for where the bottlenecks are in the economy, what sort of inflation pressures are starting to emerge, and whether we think the rate of growth is sustainable. So much of our forecasts are based on the model projections about potential output growth, and then our forecasts of what actual output is doing and what the gap is between actual and potential output. So we rely enormously on Statistics New Zealand for data, as you would expect, on pretty well every component of our output forecasts. So be it terms of trade, be it investment, be it consumption, what's happening in the labour market, what's happening in the current account. So we're hugely dependent upon the work that you produce, and we're great supporters. We also value the comprehensive reviews of data that Stats New Zealand undertakes. Our only request, and it's not a complaint, so please don't take it as such, but it's only a request that we get a heads up as early as possible in the process. And that's because if the revisions are very large, the original stats may have had the potential to mislead policymakers. So the earlier that we can learn about upcoming revisions and what's driving them, the better off for all of us. So what are we doing? What about our efforts in the Reserve Bank? Well, 6 years ago, we developed our financial sector information system. It's known as FSIS. It's a warehouse for processing, storing and managing time series data. It's big. It holds about 36,000 time series. About 20,000 of those are macroeconomic time series relating to New Zealand and to the global economy. You'd be pleased to know that Stats New Zealand produces most of the 20,000 series, and that I'm not going to describe many of them. Most of the others, the other 16,000, are produced by us, are produced by the Reserve Bank, using our powers to collect data from institutions and turning that data into time series. So let me turn briefly to our work program. So New Zealand's financial statistics, most of which we collect ourselves, are undergoing very substantial change. And some of the key statistics we produce are in this slide. So I won't go over the individual stats, but you can see that there's some tremendously important financial statistics that we produce there. And in terms of what we've got planned or under development, these are the key things that we're thinking about. In some cases, they're business plans. In some cases, we've got templates. And in other cases, we've already been out to the industry, having discussed the templates with them, and we're starting to get into the collection phase. Our data collections, so this is the 16,000 that are our part of the data warehouse, if you like. You're the other 20,000. Our data collections have been growing substantially since the global financial crisis for three main reasons. I mean, the first is the intensity of the prudential oversight since the GFC has expanded. So we needed new data series on banks' liquid assets. We needed to understand the liquidity, given how quickly it dried up in the global financial crisis. We needed more data on funding, and something reasonably topical to most audiences that I chat with is housing lending broken down into loan-to-value ratios. So the second reason why our data collection's been growing is that our regulatory responsibilities have expanded quite a lot. Since 2008, we've taken on responsibility for prudential supervision of the non-bank deposit-taking sector. It's pretty small. It's about 40 institutions. The largest has a balance sheet of around 2 billion, but the other ones are extremely small. And we became prudential regulator and supervisor for the insurance sector. And that's a much bigger deal. That's about 100 institutions. So the third reason why our data collections have been growing is simply because of, like you, we get a lot of demands from users, from international agencies and from financial analysts for more granularity and expanded coverage, particularly on the capital market, which really has not been well captured in data in New Zealand to this point. So how do we decide? How do we decide what to produce? Like you, we have to be responsive and should be responsive to the demands for new and transparent data. And like you, we have to manage costs, we have to manage size, we have to manage complexity, and particularly to keep compliance costs to an acceptable level. We approach the exercise of what to produce and when to produce it very much as if we're investing in a long-term asset. So we need clear signals of user demand and a strong business case, particularly when the benefits from producing these statistics come many years later, when a good time series is developed. So we're making investments where we may not see the time series and the longitudinal data that may be helpful to us for many years down the track. And there's two major issues that we have to deal with in thinking about this investment proposition. The first is identifying and keeping up with structural change. And that's a tricky area. It's a tricky area. The absence of financial statistics can mask structural change simply because financial analysts have no way of measuring it. And it can be very difficult to detect structural change when it involves new financial products, when it involves unregulated institutions, and when it involves financial services from offshore. So we're constantly thinking about structural change, which is meaningful, what's material, should we be investing in particular time series data. The second is one we all face as well, which is recognising the opportunity cost of limited resources and the need to develop clear priorities in developing new series and overhauling the collection processes, improving data quality and timeliness, and providing, and this is important, providing external users of our statistics with metadata and guidance around their use. We've shortened the time span in the delivery of much of our financial data around bank credit, liquidity, solvency and debt issuance, and we've redeveloped our standard statistical return for the banking system to reflect the changes underway in the banking system and our monitoring needs. So this is the fun bit. I get to say what are our preferences. So every user of statistics has their dream team of new data series that they would love to have in an if only world. So as a major supporter of your efforts, I'd be remiss if I didn't give you our own wish list. So our top 4 requests from Statistics New Zealand would be to have sector balance sheets that would tell us who owes what to whom across the country and the rest of the world. So sector balance sheets. A quarterly income-based measure of GDP. This would provide a valuable alternative perspective on output to the existing production and expenditure-based measures. We'd also like, in this if-only world, we'd like a rebasing of GDP at the very least, every 10 years to capture the structural change in the economy. And of course, we'd dearly love to have a monthly CPI to enable more timely analysis of inflation. We know that there are many statistical needs, and that resources are limited. But New Zealand's annual GDP is around $220 billion, so better quality and more timely decisions that result in a slight improvement in economic performance can be immensely valuable. So let me conclude by saying that there is no magic. There is no magic to good policy making. Good decisions depend on good quality statistics and information. And we know how important your work is. We greatly value having a voice in Statistics New Zealand data development process. And we value our collaboration with you in helping to harmonise statistics by working off a common business register when we're putting together institutional statistics. So thanks very much indeed, and do have a great 2 days. So thank you for the invitation.
We have a couple of minutes if there are any questions while we've got Mr. Wheeler here, and I'll tell you, we have been trying to get him on Q&A all year and he keeps giving us a slide, so get some questions in because we're not able to. If the media can't do it, let's see if you can. So are there any questions in the room? Just put your hand up if you have a question for Mr. Wheeler. I've got one about the LVRs, and have you any data on it, in terms of this, though, any data around it that's starting to tell you how it's impacting? Because I know Morris will be interested in that with his other hat on.
Yeah, it is. It's still a little early, but we think they are working as we intended, which is good news. It's good news for people trying to get into the market and those that are highly leveraged at a time when interest rates are rising. If you look at the data and you look at house prices, say over the last 4 months when LVRs were introduced, and compare that with the 4 months before, then house prices nationally increased over that 4 months by about 1%. So about 1% over 4 months. For the 4 months before, they increased by 4%. So it looks as if house prices are starting to moderate. House sales are down 13%, and in Auckland it's 15% since 1 September, or 1 October, forgive me, when this was introduced. So house sales are down, house prices are moderating. We did some work that said, let's assume that we hadn't introduced LV ratios. So let's look at the counterfactual of what might have happened if banks had been continuing to lend 25 to 33%, say 30%, but it did get to 33% of their loans to people with low deposits. So let's say we'd been in that world where it continued instead of falling away under the LV ratios to around 7% at where it is at present. But the 7% is still well below the 15. The limit is 10, but there are exemptions for another 5. So banks are currently at 7. They could be at 15. But what was the effect that they've had? The counterfactual, we believe, is that house prices would have been essentially 2.5% higher nationally than what they've been now. So house prices nationally are growing at 8.5%, 8.4%. We think that if we hadn't have introduced the LV ratios, then they would be growing at around 11%.
And the impact that would have had on mortgage holders, because of course we've seen the interest rates going up in the past few days since you moved the OCR.
Well, you know, the concern I think we have is that, you know, we've got a lot of highly leveraged borrowers in this market who basically have never been through a monetary policy tightening. It's 5 years, essentially, since we tightened monetary policy. And we've talked about in our forward projections, we expect to tighten by roughly about 2 to 2.25% over the next 2 years. So there's potentially a lot of highly leveraged borrowers out there. And so our motive was to try and take some of the pressure out of the housing market before we had to get into this tightening process by introducing LV ratios. But so far, they seem to be working quite well.
Do we have any questions from the room, or shall we let Mr Wheeler get back into the shadows? Graeme Wheeler, thank you so much for your time this morning.